I spent 20 years trying to outperform my best friend financially. I bought a rental property while he quietly invested in index funds. At the time, I was absolutely certain I had made the smarter decision. I had leverage, monthly cash flow, and a real asset I could drive past. He just had numbers sitting inside a digital brokerage account. For years, I genuinely believed I was winning this race. But when we finally compared our real numbers after 2 decades, the result honestly shocked both of us to the core because one of us forgot to count the exhausting hours and the other forgot to count the growing zeros. To keep things completely fair, look at where we both started out. 20 years ago, Leo and I each had $50,000 saved from our day jobs. We earned the exact same $55,000 salary and lived in the same city. The only difference was what we did with that $50,000 stack. I used my cash as a 20% down payment on a $250,000 rental property. It was a modest 3-bedroom house in a decent neighborhood. I took out a standard 30-year mortgage with a 7% interest rate. My monthly mortgage payment came out to about $1,330. Soon, I locked in a tenant willing to pay $1,800 a month in rent. On paper, that meant an effortless $470 a month in profit. God, I felt like an absolute real estate genius back then. Meanwhile, Leo dropped his $50,000 straight into an index fund. No leverage, no tenants to deal with, and no physical keys to hold. He just set up an automatic contribution of $300 every single month. Coworkers would ask about his strategy, and he just said, index funds. They would nod politely and instantly change the subject to something else. Frankly, nobody was impressed by Leo's boring strategy. On day one, I had a real asset. Leo just had a confirmation email. It did not even feel like a close competition at first. But I did not realize it yet. This was my first massive mistake. Because feelings and mathematics are two completely different things. For the first few years, I was living the ultimate landlord dream. Rent checks hit my bank account like clockwork on the first of the month. I used to drive past that house on my way to work and smile. I claimed mortgage interest and asset depreciation to save on taxes. That strategy shaved a couple thousand off my tax bill each year. I watched comparable homes in that area steadily tick up in value. Everything about this investment felt tangible, real, and safe. Leo just logged into his account once a quarter to check the balance. He saw the total number go up a little, then down, then up again. In year one, his $50,000 grew to $55,000 and hit $61,000 by year two. It honestly did not feel like anything major was happening for him. My friends praised my house, but nobody asked Leo about his stocks. That social proof made me feel like I was winning by a mile. And then the illusion completely shattered. Let us look at the actual, unvarnished numbers through year three. I had collected roughly $64,800 in total rent over those years. My mortgage payments totaled $47,880, leaving a gross flow of $16,920. Suddenly, that easy cash flow started looking very different. Property taxes ran $3,000 a year, and insurance wiped out another $1,500. Then, reality punched me straight in the face. I replaced a broken water heater for $1,200 and fixed a leaking roof for $2,800. To make matters worse, I hit a month of painful tenant vacancy. That cost me $1,800 in lost rent plus $600 to clean and relist it. I did the property management myself to save a little extra money. But that meant stressful phone calls at 10 p.m. on weeknights. I spent my weekends doing showings and coordinated repairs on my breaks. 3 years in, I realized I had barely made any real money. After all real costs, my actual net cash flow was just $2,000 to $4,000. It was nowhere near the $16,920 that looked so beautiful on my napkin. And that tiny profit did not account for a single hour of my labor. I was essentially working a second part-time job completely for free. Leo, meanwhile, put in his $50,000 plus monthly savings, hitting $76,000. He spent 0 hours working, took 0 phone calls, and had 0 stress. But I kept telling myself that I still had the magic of leverage. My house appreciated slowly and was now worth roughly $270,000 to $280,000. My total equity had grown to roughly $55,000 to $65,000. That was real wealth, and it came from using the bank's money. It is the one massive advantage stock investors cannot replicate. But here is the catch that nobody warns you about before you buy. The rent check is the only number real estate gurus love to flash. What they never mention is everything that gets clawed back. Take vacancy. The average property sits empty about 1 month a year. That is a full mortgage payment due with 0 income to cover it. When a tenant leaves, you pay for cleaning, advertising, and screening. For maintenance, you must budget 1% to 2% of the value per year. On a $250,000 house, that means $2,500 to $5,000 annually. Some years it is a minor faucet. Other years it is a total disaster. I faced a $7,000 HVAC replacement in August that broke my savings. You cannot postpone that when your tenant is threatening to sue you. Future structural costs like roofs come in huge chunks of up to $15,000. If you do not save for this monthly, you are gambling on pure luck. Hiring a manager meant losing 8% to 10% of rent, or $150 to $180 every month. Managing it myself meant working a part-time job without pay. And then there's the one terrifying risk nobody wants to face. A nightmare tenant who stops paying rent can absolutely destroy you. An eviction can cost you 3 to 6 months of lost rent, plus steep legal fees. That single awful event will instantly erase a whole year of profit. None of this shows up in the fake cash flow numbers online. By year 5, the stress was heavily eroding my sanity. I was already on my 3rd tenant and paid $8,500 for a brand new roof. A plumbing crisis cost $1,400, and the house sat empty yet again. I raised rent to $1,950, but rising property taxes ate it all up. My actual cash-on-cash return was hovering around 3% to 5%. This was a far cry from the 15% to 20% return I told my family about. Meanwhile, Leo was still doing absolutely nothing but sleeping well. His portfolio hit $135,000 to $150,000 by year 7 with his savings. He did not try to time the market. He just left the compound engine alone. The compound growth was finally starting to explode for him. His investment gains were making more money than his actual job savings. Underneath the surface, my wealth required constant daily sacrifice. Leo's wealth grew in a beautiful curve, slowly at first, then vertical. Compounding is painfully boring for 5 years, then astonishing. But don't get me wrong, Leo faced his own psychological demons too. During the brutal 2020 crash, he watched tens of thousands vanish. The market plunged 34% in a single month, and he felt the pure terror. He admitted to me later that he almost cracked and wanted to sell it all. That is the hidden tax of the stock market: absolute volatility. Most retail investors panic at the bottom and lock in massive losses. Leo stayed disciplined, but it took a heavy toll on his nerves. By year 10, my house was worth $335,000 to $350,000 with a $166,000 balance. That put my total equity at around $170,000 to $184,000. But my extra out-of-pocket expenses had quietly drained $20,000 to $35,000. Leo's portfolio hit $165,000 to $180,000 on total contributions of $86,000. And he spent exactly 0 weekends fixing an emergency water leak. At year 10, our net worths were surprisingly close to each other. I was slightly ahead because of how I used bank leverage, but I paid for that edge with hundreds of hours of manual labor. My entire financial life was trapped in a single house and zip code. This is the exact point where our paths completely separated. By year 20, my property value rose to $450,000 to $500,000 as it cleared. My total equity sat comfortably between $400,000 and $500,000. But after 2 decades of constant repairs, my cash profit was low. I only pocketed about $40,000 to $80,000 above what I actually spent. Leo's portfolio hit $420,000 to $460,000 on total contributions of $122,000. The other $300,000 plus came entirely from pure passive compounding. He had zero debt, zero angry tenants, and zero midnight phone calls. We finished in the same net worth ballpark of $400,000 to $500,000. But the way we got to that destination was completely night and day. I actively worked for every penny, while Leo just waited patiently. If Leo had just added an extra $200 monthly, he would have hit $600,000. In stocks, you just add capital. In real estate, you add another mortgage. Of course, stocks have flaws too, like a brutal 37% market drop in 2008. Index funds offer low cash flow, yielding a tiny 1.5% to 2% in dividends. Yet neither of us truly mapped out the real psychological costs back then. I spent 20 long years building up tangible property assets. Leo spent 20 years building pure, unadulterated freedom. Next time someone tells you one strategy always wins, ask them this: did you actually include every single hidden cost in that math? Because the answer that includes everything is all that matters.